Singapore has kept its GDP growth forecast for this year at between 1% and 3%. It says this takes into account uncertainties in the external trade environment. The announcement follows a better than expected performance last year, which analysts say is unlikely to be repeated in 2025. The increase in demand for chips, petroleum and chemical products pushed Singapore's GDP to a 4.4% growth last year, outperforming expectations. While the manufacturing and trade-related services sectors are expected to continue expanding this year, it is likely to be at a slower pace. Trade restrictions imposed by US President Donald Trump could have an indirect impact on Singapore.
The current sense is that there could be a small negative impact on the Singapore economy arising from the current suite of tariff measures already implemented or being planned.
Singapore's economy remains indirectly vulnerable to US tariffs on its major trading partners, so such as on China and also potentially on the EU. And that resulting deceleration in global economic growth and trade from the current resilient conditions therefore poses downside risk to Singapore's growth outlook beyond the very near term.
Analysts say the impact of the tariffs will likely hit in the second half of the year. Already, sectors like retail trade and F&B have experienced sluggish growth, partly due to locals shifting their spending overseas.
Prices paid by consumer may stay high, so we may see elevated period of inflation in the coming months before weaker consumption lead to slower price increases, perhaps from the second half. So there's still much uncertainty around the actual path of growth for not just 2025, but into 2026 and beyond as well.
But it's not all bad news. Stronger consumption growth in the European Union and improving domestic demand in Southeast Asia could provide some support to Singapore's economy. Jobs and wages are also expected to remain steady.
We do not expect any major impact on wage and employment numbers because of the slower growth numbers. But of course, we will monitor these closely. But so far, both the vacancy rates, the unemployment levels, retrenchments levels have all been very stable. So we don't see any cause for concern at this point.
Outward-oriented sectors like finance and tech are also projected to register healthy growth thanks to increased demand for digital solutions and more cross-border payment activities. And for more analysis, I'm now joined by Barnabas Gan, Acting Group Chief Economist at RHB Bank. Mr. Gan, welcome to the program.
Thank you so much.
The 4.4% economic expansion outpaced earlier estimates of 4%. How did we fare compared to other major economies in the region?
I think it's important to note that ASEAN as a region has actually performed well in the last year. We have been supported by semiconductors, electronics, and in Singapore's context as well, the biomedical manufacturing and the precision engineering sectors have been performing very well indeed. So I think across the region, probably there are different growth drivers, Singapore included. There has been increased tourism as well into Thailand, Indonesia, a stronger consumption patterns in this consumption-based economies. But Singapore, given the very small but very highly relevant economy, has been very much supported by the external factors, in fact, for last year.
Okay, and do you anticipate the stronger growth in 2024 to lead to high inflationary pressures in the short to medium long term?
So the thing is that Singapore's price pressures is very much influenced by external factors because we are a price taker. It's less driven by consumption-led drivers, such as higher consumption patterns that could raise prices. I think some of the various variables that we look at very closely would be, energy prices, base metal prices, especially import prices into Singapore, that will have a very direct influence on our consumer prices. I think at this stage, we are seeing some moderation in commodity prices, so that's a relief, for inflation for the matter. But probably we have to stay cognizant over what policy measures that US may introduce in the coming days, weeks, months, for that matter. And that could actually have a very, very strong driver for how prices may trend in the region, especially Singapore.
And growth forecast for 2025, we saw that it remained unchanged at 1 to 3%. Consumption is lackluster with locals shifting their spending overseas. Do you anticipate this trend to last, or is there room for, improvement to move towards a consumption-led growth?
I think the thing is that the consumption-led growth, an idea perhaps works well in other developing ASEAN. But the thing is that consumption as a percentage of GDP of Singapore is less than 50%. So that basically suggests that if we are going to adopt a consumption pattern, then probably there may be some loss, in growth or production output, growth output that may be seen in the coming year. So I think probably, given that we are a small but very open economy, trade, more so total trade is 300% of GDP. So essentially, this suggests that a external driver for growth for Singapore will likely still be the mainstay driver for 2025.
Should businesses and investors adopt a more cautious approach then with this moderate growth, bearing in mind geopolitical uncertainties?
Yeah, so the thing is that leading to what I just mentioned, that trade and probably the external activities is part and parcel of Singapore's growth, then that perhaps brings us the question of how the external environment is going to pan out, for Singapore. I think for that matter, we are looking for, and we are pretty optimistic about it. We are looking at 3% growth for Singapore for 2025. That's a top bound. If we look at the 1 to 3% growth that officials have estimated. And I think some of the reasons behind this is because we are less pessimistic on what US-led tariffs may pan out or may materialize. I mean, we have to remember the fact that there has been instances that tariff threats has been put back, by Trump himself just recently. In fact, and in his past presidency, this same evidence was seen as well, and that could probably give some consolation to the markets, perhaps that threats could just be words. We would need probably a little bit more time to see if this becomes, a real environment in the coming future.
We would want to hope for that too, isn't it? All eyes, meanwhile, are on our budget next week. How will the slower anticipated growth for 2025 impact the scale, the amount, and types of support and spending that the government will be making?
So I think it's very crucial to understand that we are on the last year of the 5-year term. Yeah. So our estimates is that the government has room to spend a little bit more, in this coming fiscal year. Really understanding the fact that we are adopting a balanced budget approach. So that essentially means that despite the higher spending across the 5 years, we will still continue to achieve the balanced budget mandate, in Singapore. So some of the things that probably we may be looking for, it's likely a consumption support and probably, business support that could continue to aid and more so and to enable the economy to really look past this political uncertainty and lead Singapore and make sure that Singapore still remains to be relevant in tomorrow's economy.
All right, Mr. Gan, I appreciate your insights. Thank you so much for coming in. That was Barnabas Gan, acting Group Chief Economist at RHB Bank.